Okay, hi everyone. This is going to be the second lecture on chapter 22. So we are picking this up here, looking at shareholder basis, okay? And we said the reason we care about basis, it's the same as partnerships in the sense that, hey, if we go to sell our stock in the S Corp, it's going to trigger a disposition event, namely the amount realized, what we sell it for, minus our adjusted basis gives us our gain or loss. In this way, right, if you sell your S Corp stock for $1 million and you paid 400, hey, you have a $600,000 gain, okay? However, if you don't track your basis, which is a common mistake that happens, then they're going to put a zero in there, right? So you sell it for $1 million minus zero, you have a $1 million gain. So a much bigger tax liability there. Likewise, the other thing we care about with basis is it comes into play with regard to the passive activity loss rules. It's the first hurdle you got to jump through. Now, when we're talking about S Corp basis, it's similar to partnership basis insofar that there is an initial basis, which we're going to look at, generally guided by Section 351 C Corp area rules. And then there's your adjusted basis, where it adjusts or changes over time. Now, when we're looking at our initial tax basis, essentially the rule is going to be a carryover basis. So, hey, you give $20,000 in cash for your your S Corp stock. Well, your basis in that S Corp stock is going to be $20,000. If you give a machine that has a fair market value of 50 and an adjusted basis of 40, well, your basis then in the stock will be 40. In other words, whatever the basis in the item or property you gave, 40 is now your basis in the S Corp stock, right? And the idea with this is Section 351, we're looking at it. We're trying to encourage people to form corporations. And in this way, right, there's going to be tax deferral. They're going to kick the can on that gain whenever you contribute property up front. So by way of example, right, you contribute a machine. Let's just say your basis in it is 40 and it's worth 100, right? And you give that machine and you get your stock, right? Well, the idea here is this is a disposition event. In short, right, you should have a $60,000 gain. We're going to treat it like you sold it for 100 minus 40 gives you 60. The idea with this is if you meet 351, which basically says, hey, you give property for stock and thereafter you control the corporation, you own 80%, or the control group measured collectively own 80%. The idea with this is we're going to kick the can on this gain until later on, right? So it's deferred. So that's the idea here, right? Whatever your basis was and what you gave that machine is now going to be your basis in the stock. And you can see it gets a little bit, wonky down here. You got to back out any liabilities transferred. So, hey, if there's a debt on that machine, you got to back it out if the corporation were to assume it. Don't worry about any of these other items for purposes of the S Corp chapter, in the sense that corporate formation is discussed in another chapter, kind of these nuanced items here. But let's look at, let's see here, example 2212, just to give this some numbers. Right, so we got 3 shareholders here, right? 2 of them give cash, right? So their cash is going to be their basis in their stock. Then we got another guy who gives some cash, and then he gives land, right? So the idea with this is when we look at the land, it's going to be, we'll ignore the fair market value, a carryover basis. However, it looks like there was a mortgage or some kind of debt on that land. The S Corp was like, look, no big deal. We'll just take on that debt. We'll pay it, the 40 grand. So what you do here, right, it's going to be the 30 cash plus the 125 adjusted basis for the land minus the 40. Hey, the initial basis for shareholder one in these guys, right? 115, 120, 120. That's our initial basis. Once we get our initial basis, right, then it's going to adjust and change over time, right? So we can look at kind of this guy right here. So we have our initial basis over here. We said it was 40, right? We're going to have some additions to that. We're going to have some subtractions, right? So there's kind of like our beginning plus our additions minus our subtraction gets us our ending. What are our additions, right? Well, did we make any more contributions, right? Maybe we gave some cash for more stock. What was our share of the income, right? Did we make any distributions? Likewise, what was our share of any of those losses or separately stated losses, right? So I don't know if maybe we started with 40 plus 5 minus 2. Our ending basis is going to be 43. And a few things here, right, to be aware of is our ending basis can never fall below 0. And the other item here to be aware of is there's no liabilities in this, right? If you remember with a partnership when there was like 60,000 of debt that the partnership owed, we would break that out like 20, 20, 20, and that goes into your basis. When we're talking about the corporation and any external debts it has, that's not going to be part of S Corp basis. We will talk about something called debt basis, but for right now, let's just stick with that. So let's look here at 2213. Right, so we looked at in 2212 that beginning basis, right, the 115, the 120, the 120. Hey, we're going to have our additions, our subtractions, right, for our share of income, dividends, right, so on and so forth. In this case, here's our ending basis, right? Remember, it can't go below 0, and there's nothing in this that deals with the S Corp's liabilities itself. For partnership, yeah, you would have that. For S Corp, the general rule is going to be no. Okay, so we talked about before the passive activity loss rules. Again, they come into play with S Corps, right? If you have a loss, a flow-through loss from an S Corp, the best you're going to be able to do with that is offset other passive income, right? But we got those 3 hurdles that you got to jump through, right? Beginning with the tax basis hurdle, right? This is going to be your basis. We just look at your adjusted basis, right? The 43 right here, right? So that's the idea with it. Remember, we don't include, as a general rule, any external debts of the S Corp. However, right, do be aware there's something called a debt basis, right? And the idea with the debt basis is that if you have losses in excess of your tax basis, then you will reduce your debt basis. But let's look at 2214 first, just kind of break it out step by step here. This says, hey, we have a $14,000 basis, right? That's hurdle 1. It says there's a $60,000 loss, and 1/3 of that loss is going to flow through to the shareholder. What's going on here? Right, well, we have a $20,000 loss, right? It hits the first hurdle, the tax basis. Well, in this way, right, 14 is going to clear and 6 is going to be jammed up until later on. All right, so we talked a little bit about this debt basis. It kind of comes in play. It's like a basis within a basis. In other words, while we don't care about the S Corp, right, lending money or having debts to external parties, right, that doesn't come into play with our basis. If we, as the shareholder, directly loan money to the S Corp, this creates a debt basis, right? And the idea with the debt basis is whenever you're adjusting your basis, net basis adjustments, excluding distributions, reduce shareholder tax basis below zero. Then basis adjustments exceeding stock basis offset debt basis. In a subsequent year, if there's a net increase from basis adjustments, then you're going to restore debt basis up to the outstanding debt basis amount before restoring stock basis. That was just a mouthful of words, right? You probably didn't understand anything there. What's going on with this? Right, so say you have a $50 stock basis and a $10 debt basis, right? This is just going to be your outside basis, right? That beginning plus additions minus subtractions gets you ending. And then your debt basis is when you, the shareholder, make direct loans. Hey, I'm going to loan you S Corp money. That creates a second basis. All right, so say that we have, I don't know, a $55 loss that comes through, right? So we're going to hurdle 1, right? We have a passive loss. Here we can offset 50 of our stock basis, right? Take that down to 0, but we have a $5 loss left. That's when we come over and we'll offset this by 5, right? Take care of all of the loss. Our ending stock basis will be 0. Our ending debt basis will be 5, right? If we have subsequent gains, right? Say in year 2, there was, I don't know, a $15 gain, right? A positive basis adjustment. Here, first thing you do is restore the debt basis back up to 10, right? So we had 15, we just bumped it up that by 5. Then we got to take this up by 10. Okay, so that's the idea there. Let's look at 2215 to give this some numbers. Right, so it looks like we got a stock basis of 14,000. Right, that's our beginning stock basis. We have an $8,000 debt basis. And then they're telling us that, hey, it looks like there must have been a $20,000 loss. All right, so we're going to try to follow the passive activity loss rules. The first here is the stock or tax basis amount, right? So we're going to have 20,000 come through. Looks like that's going to knock down our stock basis to 0, right? There'll be an additional, in this case, once we take down the stock basis, there'll be 6 left, right? Which is going to take this guy down to 2, right? So whenever you have net negative basis adjustments, first thing you do is take down stock, then you take down debt. But if, right, so this right here was at the end of year 1. Right, so I'll just make that blue for year 1, end of year 1. Now let's say in year 2, right, it looks like there was $9,000 of income. Right, so first thing we got to do is take our debt basis, restore that first. So it's a 2, we got to get it back up to 8. Right, so 9, we took it up by 6. That must mean there's 3 that carries over. So this guy is now 3. Right, so at the end of year 2, our ending stock and debt basis will be 3 and 8 respectively. Okay, the next thing here, the at-risk amount. So that's the second hurdle, right? This is generally, a lot of the times it's going to be the same amount as your tax basis, but it is going to exclude any non-recourse debt. One of the things to be aware of here is this post-termination transition period. And this basically says, right, I don't know, say we had a $100 loss, right, that came through, and say that we had, just trying to get, I don't know, let's just say a $70 tax basis and a $60 at-risk basis. Okay, so we know if we're doing the hurdles, right, 70 clears and 30 is going to be jammed up, right? You take the 70 over, 60 clears, and then 10 is going to be jammed up, right? The idea with these ones that are jammed up, right, the general rule is going to be, hey, once you later on in the subsequent year puff up your stock basis, your at-risk basis, right, you can utilize these losses then that are trapped up at that level, right? That's going to be this general rule. The exception, however, basically says a few different items here. And essentially what's going on here is once an S Corp terminates, right, you're generally not going to be able to utilize these trapped losses, right? Like these guys right here. So if you terminate, it's like, uh-oh, you know, you lose these things. However, we have this post-termination transition period, which basically says we're going to create a fiction, right? Give you, it's generally 1 year. It's the greater of like your filing date or 1 year, but let's just keep it 1 year, which basically says, hey, we will give you 1 year to build up your stock basis, to build up your at-risk basis, right? Build it up during this time. And then we're going to look at the end of that period, right? Carry it over, and we're going to treat the loss as if they occurred on the last day of this 1 year mark. So that's what the post-termination transition period is. You can think of it kind of like a second bite at the apple, right? What we mean by that is normally when an S Corp terminates, you lose these things that are kind of caged up, that are jammed up. But this rule says, hey, we'll give you like a hypothetical, a fiction 1 year period to build up your bases in these items so that you can utilize these trapped or suspended losses. Right, so that's what it's saying right there. It begins on, it ends on. And it's essentially meant to give you a window to create additional stock bases so you can utilize those trap losses. So you can look at 2216. Last hurdle here, right? The passive activity loss limitation. We've seen this before. This is just saying, hey, you can only, once you clear the first and second hurdle, you can only offset other passive income and up to that income, right? So you can't create an NOL in that area. And likewise, there's kind of this de facto fourth hurdle, this excess business loss limitation. That's essentially for like individual taxpayers. They don't give you like infinite losses you can take. Just be aware it exists. There's like very specific threshold numbers for it. You know, don't get caught up in that minutia, but you know, be aware it exists. It's kind of like a fourth hurdle. All right, so if you work for an S Corp, how do you get compensated? How do you get paid? We talked about partnerships and partners. We said they had guaranteed payments. Well, with S Corp employees, essentially that's what they can be. They can be employees. You can get a wage from it, get a W-2 there. The question becomes, right, how do you want to allocate this? How does it work, right? So say that you have an S Corp that has I don't know, 2 million in income, right? So, and let's just say there's 2 shareholders, right? So each of the shareholders, let's just say they're 50% owners, gets $1 million, right? So we'll just look at this guy right here. So I'll just draw him, right? We're going to allocate $1 million to him. How you can allocate this, right, are through wages or essentially ordinary business income that makes the basis go up. And when the basis goes up and we make a distribution, it's a tax-free return of capital. So it's basically a distribution, right? Kind of like a dividend almost. But the question becomes, right, if you're this guy right here, does it matter to you, right? Like just split it however you want, right? Well, there is, something you should be aware of here, right? If you get hit with, the W-2, right, you're going to be subject to FICA on that, right? It's a 15.3% tax. You pay half, the S corp pays half. But if they pay out a distribution, right, there is no FICA, right? So it's like, if I said to you, like, well, should we give it to the W-2? Should we give it to the distribution? You're like the tax preference, like all else being equal, you would prefer the distribution, right? Because there's no FICA. Now, the idea with this is the IRS sees this, right? And they don't like when people just put, everything, they go down this road right here and give $1 million to this. They say you got to split it. If you're an employee, you got to split it between. And at minimum, right, you have to put a reasonable amount up this pathway. So in other words, we got to look to see, hey, what's your job? How much are you working? What would it be reasonable for someone with your skills and background in light of the open market to get paid at their job, right? So if you were working for your S corp and you normally would get $100,000 a year salary for doing this kind of work, you better put 100 up here, right? So that's the idea with it. You can't just put everything down to distributions. You got to put something to the W-2, and it's not just a baby amount, right? It's not just like we'll put 1,000 up to the W-2. No, it's got to be reasonable in amount, right? So you can look at that there, but this is an important area to be aware of with S corps. People try to play kind of tax tricks with this. It's not as great as it sounds, like especially if you have like a side W-2 job, in the sense that say you make 70, 80 grand at your W-2 job and you do side work and you're like, maybe I should form an S corp for that side work. Well, once you start running the numbers of like, FICA phases out, so there's like only a marginal tax savings on that FICA. Plus, you're like, now I got to do an S corp return and pay like $4 grand or $3 grand for the CPA to do the S corp return. I got to maintain books and records. It doesn't always work out. Like this is like a classic. People are just like, form an S corp. Create an LLC, form an S corp, and then like use this tax strategy and pay yourself little wages. It's not as great as it sounds. Generally, like if you have 6 figures of income and your only income is flow through from the S corp, yeah, maybe then it makes sense. But it's always a facts and circumstances determination. A couple other items here. So, just be aware of, hey, distributions from an S corp, income from an S corp, right? When you're dealing anytime with passive income, you could be subject to the net investment income tax. There's special rules here for fringe benefits. Not as concerned about that. Let's talk about distributions, right? Because this gets tricky and you got to see what's going on here, right? So first off, let's talk about operating distributions, non-liquidating distributions. In other words, an S corp pushes out, let's just keep it simple, with cash to a shareholder, and thereafter they continue to operate. The question becomes, what are the tax consequences to the S Corp and what are the tax consequences to the shareholder, right? So the idea here is it's not just the general rule, right? It's not like it's always this, it's always that. What you got to do is, right, you kind of have to go back to the future, or I'm sorry, back to the past, but we can just, go back to the back to the past. Yeah, that's fine. Look to the history of the S Corp. In other words, was this in the past the S Corp previously taxed as a C Corp and have something called accumulated earnings and profits, right? So there's basically two setups with this, right? When we look at history here, right? So we're getting in the DeLorean, we're going 88 miles an hour. The first history or kind of timeline, right, would be something like this, right? So you have a C Corp that from day one, makes the election and they're always taxed as an S, right? So from the very beginning, all right, in the beginning, we were, a C, but then we immediately were taxed as an S. In this way, there is, and it was never taxed as a C, it was always an S, right? So there would be no accumulated earnings and profits, E&P. In distinction, right? Say we were a corporation, and for year 1, year 2, year 3, right, we were taxed as a C Corp. Then in year 4, we made an election and we were taxed as an S, right? During this window, right, we have something that we accumulated called accumulated earnings and profits. You can think of it like tax retained earnings. It's basically money or income the C Corp has made based on an economic basis standard that it is kept and not distributed into the business. It's kind of like a time bomb, right? In other words, it's money that's sitting in there that when we do push it out, it'll be taxed as a dividend to the shareholder. Now, in distinction, right, when you're an S, you don't have AEP. The thing you need to track is something called a AAA account, right? And you can, again, think of it just like a tax retained earnings account. But generally, distributions that come from AAA are not going to be taxable. All right, so if we go back here, right, we kind of have two timelines. All right, the first one is where we were always taxed as an S Corp. The general rule here is when we're looking at the shareholder who receives a cash distribution, it's not going to be taxable and they're just going to reduce their basis. Okay, it's pretty easy. However, when we look at that alternative timeline, right, and we had AEP when we were taxed as a C Corp, and we have AAA when we're taxed as an S Corp, right, the idea with this is when you have a distribution to the shareholder, you're going to draw first from the AAA, which is going to be non-taxable, and second from the AEP, which will be taxable to the shareholder, okay? So let's kind of start with timeline 1 here, right, where you were always taxed as an S. Okay, so the idea with this is the general rule is it's going to be a non-taxable distribution that just reduces basis. It's in that sort of basis formula, beginning plus additions minus subtractions, right? One of the subtractions are distributions. So if we look at 2218, so let's see, looks like we had an S Corp, there was no AEP, and it distributes $30,000 to a shareholder, right? So we have the S, it distributes $30 to the shareholder, right? Then they're telling us here the shareholder, when we look at his basis, right, his beginning basis is 20. During the year, he's allocated 15. right? So plus 15. And then we have, in this case, the distribution, right, of 30. All right, so we do 20 plus 15, 35. Our ending basis will be 5, right? So that's the idea here is we're looking at timeline 1, right? We were always taxed as an S. You could hypothetically had been a C Corp before, but didn't have any accumulated earnings and profits, right? You were at a loss every year. So technically, you don't have to always have been an S, but this is just an easier way to think of it. Generally, it's going to reduce basis, that distribution, and not be taxable. Now, if we change the facts, right, if we said it was a $40,000 distribution instead of 30, right, when you run the numbers on that, that puts you into negative 5, right? So what does this mean? So first off, your ending basis here is going to be 0, right? You can never have a negative basis. That 5 excess, right? That is going to be a capital gain. It's a distribution in excess of basis, beyond basis. All right, so we talked a little bit about this, right? We said whenever you're a C Corp in those years, you're kind of building up your accumulated earnings and profits, right? So these are like tax retained earnings. And if you remember retained earnings, right, it's like the earnings you keep in the business, right? It's like your net income. It's beginning retained earnings plus net income minus dividends equals ending, right? Once you become an S Corp, right, so all S Corps are going to have to track their accumulated adjustments account. Again, it's just like their tax retained earnings. And in this framework, right, a couple things you got to be aware of. So the first thing is this is tracked at the corporate level, not the shareholder level, right? So like whenever you did a retained earnings equation, that was for a financial statement, for an entity, for the business, right? We don't do this for each shareholder. We do it for the business to help determine the effects of a distribution on the shareholder, right? And one of the things here with the AAA account, right? So with the AEP and AAA, they're maintained at the corporate level. When we're talking about the AAA, it's a little bit interesting here because this is one of the few times where it can have a negative balance. However, it can only have a negative balance basically if the operations are at a negative. In other words, distributions cannot throw you into the negative, but NOLs can throw you into the negative, right? What does this mean? Well, first off, let's kind of take a quick look at this AAA account, then we'll look at the 2219. But again, right, it's going to be your beginning plus your additions minus your subtractions, get you your ending. You can think of AAA like, and it's not exactly, but it's like tax retained earnings. And it's your beginning plus the income of the S Corp minus any distributions, minus any losses, minus any non-deductible expenses, gives you your ending AAA balance. And again, this can be negative, but not from distributions, right? In other words, I don't know, say you had 100 plus 5, right? And you had a loss of 200, right? Your share of losses. In this case, right, it would throw you into the negative when you run the numbers. That's okay when you have, a loss or things like that that throw you into the negative. What wouldn't be okay, right, is if you had a distribution that was like 300, right? You're not allowed to have distributions take you down below negative. The best that can happen there is it can take you down to 0. But let's look here at that 2219 to kind of give this some numbers. So you can see and look at this here, right? So they're giving us some information. They want to know is what is the AAA, right? So you're going to calculate it before the distributions. Here's after the distributions. Again, it can be negative from operations, but cannot be negative from distributions. Okay. So what's the idea here? What's the outcome? So we keep talking about, it was formerly taxed as a C. It has AEP. Now it's an S Corp. It has AAA. We said if we have a distribution, a cash distribution from the corporation to the shareholder, in this S Corp, formerly was taxed as a C and now is an S, right? And it has AEP and we've been tracking the S. Well, what we do here is when we look at this distribution, we're going to pretend that it first came from AAA, and as a general rule, it's not going to be taxable or return of capital. We'll just reduce basis. And then we're going to draw from AEP where it will be taxable to the shareholder, right? Because AEP is just basically like when it was a C Corp paying a dividend. You can't get out of paying tax on dividends just by flipping over to S Corp status, right? That's like a ticking time bomb in there. Let's look here at 2220. Right, so they're giving us some information. Looks like we have an S Corp that has $24,000 of AAA and $40,000 of AEP. Right, so we have AAA from our S Corp days of 24, and we have AEP from our throwback days of 40. All right, it looks like our shareholder has a stock basis of 80, and there is a 60 total distribution, 20 to each shareholder. All right, so we have $60,000 distribution, right, in total for the S Corp. What we do here is, right, we're going to say first it comes from AAA, right? The first 24,000 of that 60 come from AAA. And then the next 36, right, are going to come from AEP, right? So this is kind of like at the entity, the macro level here. When we look at the shareholder's point of view, right, who got 20,000 total, he has a beginning basis of 80, right? What happens here is, and he's also right, a 1/3 shareholder because 60 and 20, 1/3. So he's going to get 1/3 that comes from AAA, 8,000. 1/3 come from AEP, 12,000. Right, so 8 plus 12, that makes up the 20 he got. This is going to be from its AAA, generally going to be non-taxable, reduces basis. Right, so his basis, the beginning is 80. There's no additions, but we do have a subtraction here of 8 for the dividend. His ending basis is going to be 72. This guy right here, right, this is going to be taxable because it's from AEP, right? That's like that ticking time bomb. All right, so we talked a little bit about cash distributions. Let's just talk at a high level about property distributions that are operating distributions, right? So this gets a little bit complicated, so just kind of hang in here with me. What's going on here is we have an S Corp that distributes property to a shareholder. What we essentially have to do here is treat this as a sale, right, to the S Corp, right? So we're going to do the fair market value. I don't know, let's just say it's 100 and our adjusted basis is 40, right? We have a $60 gain at the S Corp level, right? But we have our shareholder over here, right? We got to make sure that he gets in his basis his percentage of that gain, right? Maybe he's a 1/3 owner, right? And then we got to back out the dividend as well, right? So that's the idea with it here. Let's look at 2221. Okay, so we have an S Corp. It looks like they contribute long-term capital gain property to each shareholder with $24,000 fair market value, $15,000 adjusted basis. So each of them get that, but at the total aggregate level, we have the S Corp, right? They're pushing out property that has 72 and 45 adjusted basis. So amount realized minus adjusted basis, right? That gives us a $27,000 gain, right? We have our shareholder over here, right? So first off, he gets, his share of this property, worth 24 and 15. This is at the aggregate. This is at the individual level. So he has his basis over here. What are they saying his beginning basis is? $10,000. Okay. And he's a 1/3 shareholder, right? So 1/3 of that is going to increase his basis by 9. And then it looks like in this case at the individual level, right, his share was worth 24,000. We got to back that out. In this case, right, it's going to put us at -5. But remember, we said it can't go below 0, so it ends at 0 there, our ending basis, and that excess 5, right, is going to be a capital gain. So that's the idea here. When you have a property distribution, the S Corp recognizes gains, not losses, gains. That gain is going to affect the shareholder's basis, and that base formula, that's going to be, so it's going to hit the A, right, for the percentage of the gain, and then it's going to hit the S for the fair market value of the distribution, right, to the shareholder. And again, the same framework, right, is going to apply here. You got to look and see, was this formerly, taxed as a C that it has AEP, or has this always been an S and it just has AAA? Right, but that's the idea there. Finally, here, liquidating distribution. So this is just like a property distribution, what we just saw here. So this is non-liquidating property distributions. The business continues to operate thereafter. Here is a liquidating distribution, right? And essentially what happens here is we're going out of business, right? We've come to the end of the road, and essentially, hey, here's some machines, here's some money, this is it for your stock, right? It's all we have, right? And so the idea with this is you have an S Corp, you have a shareholder, right? They're going to push out property or money, right? Let's just say property, and it's a liquidating distribution. We're going out of business. Couple different things here, right? So first off, just like last time, how there's going to be a gain, right? The S Corp's going to recognize their share or the total amount of the gain or loss, right? So this is different, right? Here they recognize gain or losses if it's liquidating. If it's non-liquidating, losses are not recognized. But remember, that's going to affect the shareholder's basis from it. Likewise, another thing to be aware of, the shareholder, they're essentially treating this like they're giving their stock to this guy, right? It's basically like for the shareholder, they're going to have the amount realized minus their basis in the stock is going to give them a gain or loss, right? So it's a little bit different here from the property distribution where it's operating. Same insofar that the gain at the S Corp level flows through and hits the shareholder. Different insofar the S Corp recognizes losses which flow through to the shareholder. That doesn't happen in an operating property distribution. Likewise, another difference here is the shareholder treats this as a disposition event of their stock. It's just like, hey, we're going out of business. You don't get your stock anymore, right? Give you something, you don't have your stock. This is the best we can give you. All right, so you can look at, the idea here for these distributions. The last couple items, let's just talk about this high level. General rule is S corps do not pay tax at the entity level. They're a flow-through taxation scheme. There are 3 exceptions, right? I'm not going to test these on the exam. This is more of like an upper level analysis. So there's this built-in gains tax, excess net passive income tax, and the LIFO recapture tax. If you have those taxes, right, you're going to have to make quarterly estimated payments on them. Finally here, when we're talking about S corps, right, you're normally talking about 3/15 is the original due date, and when they extend it, right, they kick the can out to 9/15. The S corp, right, they file an 1120S. It's similar to the 1065 for the partnership, right? What you essentially do here is on page 1, you're going to get your ordinary business income, right? That is going to carry over to your Schedule K, right? And this is at the S corp level, right? So you'll have your ordinary business income or loss, and then afterwards you'll have your separately stated items. Based on the Schedule K, right, they will fill out a Schedule K1, right? So it's like you got the K at the S corp level, then you have the K1 at the shareholder level, right? So it's going to show the shareholder their share, line 1, ordinary business income. Hey, they made 240. We get 80 of that, right? That's our share of the ordinary business income. Here's the separately stated items, right? Our share of it. So with that, we're going to end here. I would say review the examples. This gets a little bit intimidating, this material. I'd really look at the examples we did in the video, kind of slow them down, look at them individually. But with that, we'll finish the lecture here.